Good evening again, everyone. Thank you for taking time out of your busy evening to join us for this webinar on Opportunity Zone Investments. I wanted to take a quick moment for some housekeeping items before I got started. Everyone's muted by default, so we won't be disrupted by anything going on in the background. When I'm talking or sharing my screen, please write in the chat box and let me know if you can't hear or see something. And also use the Q&A box to ask questions. You please locate the Q&A box. It just makes it easier to track the questions and the answers, and you'll be able to go back and look at the answers. If you use the Q&A box, the chat kind of gets chatty, for the lack of a better word. So today we'll be talking about Opportunity Zone Investments. I'm Kavita Bharatake, your host and a principal at Cherry Street Investments. Just a little bit about me. For folks who have joined and done webinars with me, you already know enough about me, but for the folks who are new on the call, I am a Texan pretty much, moved here from India, Bangalore, India to College Station, Texas, to go to Texas A&M University in '98. I was a full-time technology professional. I worked at IBM and Atlassian for almost 20 years. I'm now a full-time real estate investor since June 2019. My focus is on educating and providing investment opportunities, primarily in multifamily, but also dabble in other investment opportunities like hotels and senior assisted living and so on. And more of these webinars will be focused on all the other investment opportunities besides multifamily, which I focus on potential as a sponsor. I'm a single mom to a teenage daughter. She's 15, and I have two puppies, Milo and Ario. Before I started multifamily investments as a sponsor, I went through stocks, options trading, landlording. I own a bunch of single family homes in Austin and San Antonio, as well as some small duplexes and multifamilies. And I finally got into multifamily about 2017, and I've been focused on that since. I also did an Opportunity Zone investment myself earlier this year to get through a stock sale that I did in 2018 when my company went public a few years ago. So that's how I learned about the Opportunity Zone investment, and I got into it and tried to share that knowledge with other people, because there are a lot of myths and myths about opportunity zones that everybody's peddling. I see this with brokers all the time. They'll try to sell properties based on the fact that it's in an opportunity zone. And my hope today is that you'll take away from this presentation is that it's just not enough for a property to be in an opportunity zone. There's a lot of other regulations around it for taking advantage of the tax benefits that opportunity zones provide. I'm also a passive investor. I have my own passive investments in multifamily, and now I've been an active investor as well. This is a quick disclaimer that this presentation is for educational purposes only, and there is no solicitation, or I'm not selling any opportunity zone investments here. Please consult, and this is just for folks to learn about opportunity zones. And I don't like to go through disclaimers, but I was told I should have them. Please consult your attorney, financial advisor, and CPA for all legal matters and your specific tax situations. This generally applies to most situations, but if you have anything specific, please consult your CPA for it. It's been said that there's nothing in this world. Nothing can be said to be certain except death and taxes. And Benjamin Franklin said this in 1817. It was probably true back then that you couldn't escape death. I mean, it's still probably true that we can't escape death, but it is not so true that we can escape taxes. And this presentation focuses on not necessarily escaping taxes, but learning how to find the loopholes and find tax breaks when we can get them. I saw this yesterday, and it really jumped up at me. For the first time in history, the super rich, which is the 400 richest families in the country, have paid less taxes or less tax bracket than the bottom 50% of the country. So what this essentially means is that bottom 50%, according to the this post in Washington Post, this article in Washington Post. You're welcome to look at that link, and I'll be sending that out later. The bottom 50% of America paid 24.2% effective tax rate, and the top 400 families paid less than that, which is 23%, a full percentage less than what the bottom 50%. So this is really a testimony to saying that you can really get away from paying taxes. So in that sense, Benjamin Franklin did not know about the tax breaks that we're getting lately. So if you guys can guess, what is the biggest source of tax breaks that people are taking advantage of, that the wealthy are taking advantage of, it will come no surprise that it's real estate. Whether it's real estate above the ground or real estate under the ground, well, by that I mean oil, those are huge tax breaks that people get and are able to apply to their income, whether it's from a business or it's from a job. And generally, most of the wealthy obviously own businesses, so that gives them further advantage in taking the tax breaks. So the question is there an opportunity for you in an opportunity zone investment? And the answer is, it depends. I don't think you should do an opportunity zone investment just because it's a good investment, or just because you want to save on taxes rather, but you should do an opportunity zone investments if it's a good investment, for one, and two, it saves on taxes as well. So I think the tax savings has to be an additional benefit and not the main reason why you're doing an opportunity zone investment. And the next few slides, I'll talk about why this is so important, because there's a lot of investments out there that people are selling in opportunity zones that are not necessarily good investments because the locations are not great. So you have to be really careful when making an opportunity zone investment, that it's for the right reasons, which is the tax benefit, of course, but that it's also a good investment to start with. So today what we're going to cover is, what are opportunity zones? Why should you make opportunity zone investments? We'll talk a little bit about the taxes, the timelines, and a little bit more about opportunity zone investments. We will talk about what a qualified opportunity zone is. What are some of the regulatory requirements? And I'm going to keep this very high level. There's a lot of dead information up there that you can pull up. But just as an introductory webinar, I'm going to keep this high level and easily understandable. Some of the things, we'll also talk about some of the things to evaluate in an opportunity when looking at an opportunity zone fund. And finally, some opportunity zone links and resources, which I'm happy to share. And if you have any questions, and there are, just a quick note, I saw some questions come up on Q&A. I'm going to answer the questions at the end of the webinar, just because it takes me away from the timeline to finishing on time, and I want to be respectful of all your time. So what are opportunity zones? This is a new program created by the Tax Cuts and Jobs Act of 2017, and it passed December 2017. What opportunity zones are specially designated census tracts. They're basically geographical areas that are designated as opportunity zones. And I believe that the local government as well as the state government had a big part to play in identifying these opportunity zones, and that sort of rolled up to the federal government. The first set of opportunity zones covered almost 18 states and was designated in April 2018. As you can imagine, it's not been that long. It's just been about a year and a half. It's not been that long that we have even had this concept of opportunity zones. So there isn't really a huge expert on this or expertise on this, although there are companies that specialize in opportunity zones, and there are funds and companies that are sponsoring those funds who have been in it a lot longer than some others. Opportunity zones have been designated to now cover all of the 50 states, the District of Columbia, as well as the 5 US territories, and notably Puerto Rico, as was added as a opportunity zone. The entire territory of Puerto Rico was added as an opportunity zone recently, I think it was a few months ago. So just for economic growth development there. So the purpose, as you can imagine, is to increase capital infusion by designating these areas as opportunity zones. So investors are inclined to invest in these opportunity zones, and that spurs the economic development. So essentially, the majority, if you look at the majority of eligible census tract, they are in the low income area. But interestingly, some of them are in the middle and high income areas as well. Case in point, I always like Louisville. Louisville has a median income in the $70,000 plus range, and it's in an opportunity zone. A big part of Louisville is in an opportunity zone, which is interesting because it's not a low income area. So when I talk about location and opportunity zones, it's very important to keep in mind that you don't necessarily want to go put all your money in a $25,000 income area because your returns are not going to be fabulous. So that's something to keep in mind. Essentially, the opportunity zone allows investors to reinvest their capital gains into businesses, real estate, as well as business assets which are located in opportunity zones. So what's in it for you to invest in an opportunity zone? You get substantial tax benefits when you invest in an opportunity zone, and I'll talk about the details of these tax benefits. You can also be used to defer taxes of any kind on realized capital gains. What I mean by that is when you look at real estate, you have a 1031, the concept of a 1031 exchange, which allows you to defer capital gains. So let's say you have a property and you made some money on the property, you could do a 1031 exchange into a like kind of property. So it doesn't have to be single family to single family. Let's say I do a single family to multifamily. And essentially you don't pay taxes, but you have to roll over your entire proceeds. But let's say you have stock sale or crypto sale, or you've sold a business, or you sell a piece of art. There's really no way for you to get away from the capital taxes that you owe on those. But now Opportunity Zones provides you a way to do that. So that's one of the big things, big draws of Opportunity Zones. It's not just for real estate, it's for real estate and then some. Another big thing is that it allows for many benefits over a course of a 10-year hold. The hold period is rather long in an opportunity zone investment. It's 10-year minimum. And there are incentives provided at 5, 7, and 10-year thresholds. And we'll talk about what these incentives are. Let's talk about an opportunity zone fund. An opportunity zone fund is essentially a vehicle organized as a corporation or a partnership. The idea is of an opportunity zone fund is to collect the investments, the dollars for investing in an opportunity zone. And further, a qualified opportunity zone is defined as a self-certified entity. You have a certification process with IRS as an opportunity fund. 90% of these funds in a qualified opportunity fund, to be qualified, have to go towards an OZ area investment. So what I mean by that is if I make $1 million fund, 900,000 of that $1 million has to go into the OZ area. I can't use it for any other purpose. The remaining 10% I could. It should also meet the substantial improvement test. And this is something I really want to emphasize. I just had, when I posted the Opportunity Zone webinar today, I had a broker reach out to me and tell me about Opportunity Zone investment he had for me. And I want to point out that just having a property in an Opportunity Zone doesn't help. And the reason is you have to meet the substantial improvement test, which means you have to double the basis in the property within 30 months of acquisition. What I mean by this is, let's say I have $1 million property, and I have about, let's say the land value is about 200,000 of the million. So my improvement value is now 800,000. Now, Opportunity Zone substantial improvement test requires that I double the basis, which means I have to add an additional $800,000 into the property within 30 months of my acquisition of the property. As you can imagine, this is very hard to do in a typical apartment investment or a typical investment that I go out and buy that is cash flowing and producing and occupied, fully occupied. We are not generally not buying these heavy value add opportunities, because generally what that would mean is it should almost be not occupied and it should not be really making money for me to pour that kind of money into a property. And this is something most people fail to understand when they promote opportunity zone investments. Also, a majority of the land under consideration has to be in a designated OZ tract. What I mean by that is it's quite possible that if you own a few acres of land with some development on it, some part of it might be in an opportunity zone and some part might not. And the requirements demand that you own majority, which I assume is more than 50% in terms of square footage of the land to be in an OZ tract. Further, tax benefits can be combined with bonus depreciation. If folks are not aware of what bonus depreciation is, I wanted to just quickly clarify. With the Tax and Reform Act, the same act, they created this concept of bonus depreciation, which allows you to take the normal depreciation all in the first year, which means 100% of the depreciation on an apartment or a commercial building can be taken the first year. So opportunity zone benefits can be combined with bonus depreciation, which is an icing on the cake. So let's talk about the queue of compliance. Not every opportunity fund is qualified. So it requires that to be qualified, an opportunity fund has to meet some compliance requirements. One of them is that the funds in the qualified opportunity fund has to be deployed within 90 days with the property. So essentially, a sponsor cannot hold your funds, have it sitting in the opportunity fund, in the bank account or wherever they're holding the fund for more than 90 days without deploying it in a qualified opportunity zone property. Every 6 months, compliance auditing will be performed on these opportunity zones. And if not compliant, fines may be assessed by IRS. And the rules are still being fleshed out with IRS, and we keep having a constant different rounds of rules being fleshed out, because there's still a lot of questions around this, and the questions are being answered and things are being formulated right now. There are a lot of working groups with representations from large OZ funds as well as OZ advisory firms. I'm just going to have a quick peek at the questions to see what kind of questions are coming in. And of course, I can't see the questions, so I'll move on. Okay. Let's talk about a queue of investment timeline. So it's 2019, and I sold a property, or I sold some asset. I mean, the numbers here are small, just to keep things simpler. You can scale it up, 100-fold, 1,000-fold, as it might be. So let's say January 1st, 2019. I sell an asset and I generate $100 of capital gain. Let's say I actually invested $300 or $200 and made $300. And now I have a tax liability of $200 or $100. Sorry, I made a gain of $100. So only the gains need to be invested in the QF and not the original principal. And this is very different from a 1031 exchange, and we'll talk about why that is. Now, within 6 months or 180 days of the sale of the asset, assuming I sold on January 1st, I have to have this invested into an opportunity fund. So I take the entire capital gain and I invest it in an opportunity fund. Now the QOF invests the $100 into a QOZ property within the 90-day requirement. Now you're considered to have a $0 basis in the investment. And I'll talk about how that works. So in 5 years, essentially what happens is there is a step up in basis. So you assume that the basis is $0 to start with, and now your basis has become $10. So this basis is essentially stepped up by 10% in 5 years, which is 2024. In 7 years, the basis is stepped up another 5% for a total of 15%. What this means is that instead of now paying taxes on the $100 of capital gain, I only pay taxes on $85 of the capital gain, because now I have a step up in basis of 15%, which is $15 in this case. So essentially in June 30th, 2026, my basis changes to $85 instead of $100. And I owe taxes on $85 on December 31st, 2026. So this is not necessarily the 7-year mark. You have to pay, all taxes are due by December 31st, 2026. And that's how it's been set up, which means if you get into the investment later, you might not get the entire 7 years available. So after December this year, you're not going to get the 7-year period. You're still going to get all the benefits, but you're just not going to get 7 years to pay up your taxes. And what's interesting is after 10 years, on June 30th, 2029, let's say I sell the QOF for $200. So remember, I invested $100 in capital gain. Now I sold it for $200. Now your basis in your QOF is deemed to be fair market value. So there is zero taxes due on any appreciation within the fund. And I think this is one of the best things about the Opportunity Fund, is that it not only gives you a chance to grow your cash without paying taxes for 7 years, but also you don't have to have a tax liability after 10 years. And this is very critical. So let's take an example. Let's say I have a traditional portfolio investment. I have an original gain of 200K. I think or 2 million in this case, sorry. I think there was one too many zeros in the top example. It should be 200,000. So I'm assuming a tax rate of 37% that I'm paying for this, and a 10% appreciation in both cases on the right and the left side. We'll look at the first traditional portfolio investment and how that's going to look in 10 years. Assuming 37% taxes and 10% annual appreciation, which is very easy to do in most commercial investments. So I have an original gain, I have a 37% taxes, that amounts to $74,000 right here. Now, the amount that I have left over after paying taxes is $126,000. And now the value, assuming a 10% annual appreciation, is $326 after 10 years. Now I get to pay taxes, obviously, after 10 years on the appreciation that I've had between 126 and 326. So that's about $200,000, and I pay at a tax rate of 37 again. So that's 74,300. Effectively, your net return is now 252K. Let's look at an opportunity zone investment and how that will look. You have an original gain again of 200,000. Let's cross the 10 off here. That's a typo. Now you have a tax rate of 37%, same annual appreciation. So your original gain now you don't pay any taxes. It goes into the Opportunity Fund without you paying taxes. So you get off on the taxes when you invest, the year you invest. So if 2019 you're making investment, you don't get to pay taxes on this, $0 basically. Now your tax liability is $0. Your total amount invested is the entire 200,000 instead of the 126,000. Now, because you have a higher investment to start with, your value after 10 years with the same annual appreciation of 10% is 518. And you can see what a big difference that makes, right? 326 and 518 already. Now, the bonus on the icing on the cake is that you don't pay any taxes on the appreciation. $0. But what you do pay taxes is that's 62,900, which is after a 15% step up in basis. So if your original taxes were 74,000, you actually ended up paying 62,900 after 7 years, or December 2026, whichever is earlier. So effectively, your net return is now 455,848. What does that mean to you? You have 1.8x growth using an Opportunity Zone fund. It's pretty phenomenal. So for those of you who are familiar with 1031 exchanges and in real estate, this sort of highlights how it's very different, and it's sort of similar in some ways as well. So if you look at the investment amount, I think this is one of the big things I like about Opportunity Funds versus doing a 1031 exchange. You get to keep the principal. You get to put only the gains in an Opportunity Fund. Whereas in a 1031 exchange, if you sell a property for $1 million, you're taking the entire proceeds and putting it in the new property. You can't take any portion of the proceeds. Whereas in an opportunity fund, I only take the gains and I collect my original principal back, and I still get all the tax benefits, which is interesting. Another important distinction is that the source of funds can be from anything literally for opportunity funds, stocks, options, crypto, real estate, and more. Whereas 1031 exchanges primarily apply only to real estate, and they require a like-to-like sort of exchange. You don't need a custodian for opportunity fund. You get the money in your bank account and you take the gains out and you go invest it. And you can even invest a portion of your gains. You don't have to invest all of your gains. But remember, whatever portion of your gains you don't invest, you do pay taxes on, which might be completely acceptable. And I will talk about when that is acceptable. The other difference is in a 1031 exchange, you're required to have a custodian. Your money goes directly at sale to the custodian. If it hits your bank account, you cannot do a 1031 exchange anymore. So a custodian gets your funds and they get to hold it for 6 months. So that's another issue to consider there, that the capital is stuck there for 6 months or whenever you deploy it into a property. The investment timelines are similar. It's 180 days from the event, but you have an additional deadline in a 1031 exchange, which is 45 days to identify candidate properties. So you have to do an identification of 3 properties within 45 days in a 1031 exchange. Here, it's just 180 days and your money is not held in any fund. It's in your account. It's where you want it to be. The investment location in 1031 exchange they don't have any location preference, as long as it's a real estate asset, or it's called DST, or a Delaware statutory trust. I can't say that word at all. An opportunity fund obviously has to invest in an identified opportunity zone area. The minimum hold period in 1031, you can go from one real estate asset to another. And there are no tax-free withdrawals of money though. You just have to keep indefinitely going from one real estate investment to another. The minimum hold is obviously, as we discussed earlier, 5%. You have that's the 5 years is the minimum hold period, literally, if you want to see any tax benefit, and you get a 10% step up in basis in 5 years. At 7%, at 7 years, you get a 15% step up in basis, and the taxes are due in 7 years on the original investment. And then in 10 years, you get a tax-free withdrawal of all gains within the fund. So how do you evaluate a QO of your investment? So I did an investment, not as a sponsor, but as a passive investor into a qualified opportunity fund after I sold some stock last year. So I kind of went through a methodical process to identify the different in QF investments. I mean, I didn't know anything about anything, so I started from scratch. It helped that I had a background in multifamily investments and evaluating them. So I took that into consideration and I came up with a few ground rules for myself. So I want to share this with you. One, the sponsor is always the most important person in any deal. In any investment you do, the sponsor is absolutely critical. Normally, we look at the track record for a sponsor in any deal. Unfortunately, the OZ deals are fairly new and there's no real track record you can ask the sponsor for, considering that it's a 10-year hold and it just started last year. But I'd still look for track record in non-OZ investments. Like the sponsor should have done other investments, hopefully, and not a newbie jumping into OZ investments. So what is the track record? Did they pay on time? Did they make the distributions on time? What kind of exits do they have? How many exits do they have? Things like that are things you need to understand about the sponsor. The other one was the asset classes. What kind of asset classes are you investing in? And that's more a deal thing, not so much a sponsor. Also, as far as asset classes under consideration and sponsors, I want to mention that if the sponsor is primarily doing a multifamily investment, you don't want them to be starting a hotel project, right? Unless they have good people on their team and track record on their team with that kind of investment, then it's fine. But if it's a sponsor who has done all the previous investments in a different asset class, then it's really important that they stay with that asset class or bring in help or bring in people on the sponsorship team with knowledge of other assets. It's also important that they have a good knowledge of the OZ regulations, because following the regulations is important. And in my own experience, talking to a lot of people, I realized that a lot of OZ funds had the folks had no clue how to actually what the regulations were, when to collect the money. They just went, and it's a self-certification process. So literally anyone can do it. You and me can do it too. But it doesn't mean anything to set up a fund if you're not going to follow all the regulations. Also, an important thing which you should have in any kind of investment is communication responsiveness of the sponsorship team is important. The location is always, of course, important in real estate, as they say, location, but it's more so very, very important in an opportunity zone investment, because a lot of these investments are in areas which are not desirable and areas which you probably won't make much money unless it's an up and coming area or in the path of progress, what we call gentrification. So there are opportunity zones which are low income right now, but they are hugely in the path of gentrification. And I've seen some of those in San Antonio. There was an interesting opportunity zone investment that I came across in San Antonio, which is on the Riverwalk. So literally the edge of an opportunity zone, and the entire hotel is on the Riverwalk, which is obviously, if you know San Antonio, it's a very desirable area of town. So it's very important to keep in mind the target market and submarket. And I urge you to, if you're making an investment, I highly recommend that you look at the median income, the crime rate, the poverty rate, and not just for the zip code, but for the immediate area, because a lot of things can change within a zip code. You can get most of this data at city-data.com and some other links that I shared in my earlier webinar on due diligence. Now, the deal itself. I looked at a couple of things. Even with the location, I looked at states that I wanted to be invested in. So the top of my list was Arizona and Texas, because we are seeing one of the biggest growth periods in the history of these states, where a lot of money and a lot of businesses are moving into these states. So I consider them very favorable in the long term. Like the next 10 years, I consider that these markets are definitely going to grow. And of course, not every part of that market will grow. So you have to be aware of the submarket as well. Now, looking at the deal itself, what are the asset classes that they're going to invest in? Hotels, multifamily, senior assisted living. It could be self-storage. It could be so many things. Now, what's important here is, do you want to be invested in that asset? Are you comfortable with that asset? For example, for myself, speaking for myself, I'm not very comfortable with office buildings and retail strip malls at this point in the market cycle, simply because I feel like they will go through a harder time in the next few years and in the downturn. I'm more comfortable with multifamily and some other investments than with retail and office buildings, because they tend to do better over a recession period. And we're expecting one for a long time now, and we are starting to see all signs of it. Also, is that fund exposing you to multiple properties or a single property? So that found that opportunity zone funds, which invest in one property, versus some others which have 5 properties that they'll be investing in. And I like the concept of investing into 5 properties and getting exposure to multiple asset classes, sort of diversification within the fund itself. So that was a nice benefit. There's also a new construction or heavy value add project. So you have to make sure that you know what you're getting into. New construction carries more risk, whereas a heavy value add project might carry less risk than new construction, because there might be budget overruns on new construction that you might not even see on a heavy value add project, because you already have an existing building. A typical example of a heavy value add project that I found in opportunity zone investments were not taking functional apartments, and because they were in opportunity zones, it's really hard to double the value. But for example, I took a hotel, or I took an apartment and converted it to a hotel. I took a hotel and converted it into an apartment building. That requires a substantial amount of capital infusion, and therefore it's easier to meet that substantial improvement test. There were other factors I considered, which were fees and overhead. Typically, the fees for new construction will be higher in favor of the sponsors. So your splits might be 60-40 or 50-50 some cases too. So because the sponsors are going to put in a lot more time and effort for construction, and they also charge for that, right? Their time. The distribution timeline. I found this another important factor which was specific to opportunity zones, because remember that your taxes are due by December 2026. So if you have a huge amount of gain tucked away, those taxes are going to come up on December 2026, and you want to make sure that the sponsor is returning enough money to you over those 7 years that you can make your tax liability, you can meet your tax liability and pay up your taxes. So ask them for distribution timelines. When will they be distributing? Typically for new construction, nobody distributes the first year or two, right? You're going to start seeing distributions after 2 years typically. So keep that in mind and understand what the sponsor team is planning to do for you, so you can meet your tax liability. Some of them will do sort of a refinance within 5 years. So they return your original capital or some portion of it so you can meet your tax liability. Also, look at the exit strategy. How are they planning to exit the property? And obviously they have to hold it for 10 years, but not necessarily, because they can roll over from one property to another property in an opportunity zone and still keep their opportunity zone status for the fund. So that's possible. They could refinance and give some portion of your capital back in a few years once the building is functional. So understand all of these factors before evaluating an investment, or while you're evaluating an investment. Some of the other factors to consider. This is something I touched upon earlier. Is there an opportunity for you in opportunity zone? Yes, I think the first question to ask there is, would I make this investment if it wasn't for the tax benefits? And I think that's a very important question to ask yourself. Is this a good investment, right? Is the long hold period of 10 years and loss of liquidity acceptable to me? So you're going to lose money. You can't really use that money for 10 years. It's stuck in an opportunity zone fund. So you don't have access. And most sponsors won't have any concept of liquidation of this asset or liquidation of your investment into the hold period, because they don't plan to sell it and they don't really give you an option to get out of it. The other question is, where is the market going to be in 10 years? We don't have a crystal ball. We'll never know. You can only guess. My guess was that we'll be on the other side of a recession, because assuming we'll hit one in the next couple of years, next year maybe, usually it lasts about 18 to 24 months, a typical recession. So 10 years should be a pretty safe timeline for us not to hit another one, maybe 7 to 10 years, who knows. So where will the market be in 10 years? Probably favorable if you invested in a good location. Also, something to look at is the opportunity zone investments are typically offered much lower IRRs than some of the other investments that I looked at. So I do multifamily investments, and we typically offer about 16 to 17% IRR over a 5-year hold period. Now, most of the opportunity funds offer between 12 and 14, 12 being, even 10 being on the lower side actually, but average of 12 and high of 14. So that's something to keep in mind. Am I potentially losing out on making more money on my money than I could if I did a non-opportunity zone fund? Is it better for me to just pay my taxes and make my money work for me? Another good reason why you might do an opportunity zone investment is that you missed your 1031 exchange window. You had a 45-day identification period, you missed it. So you can still take advantage of it with an opportunity zone, because you can invest it in an opportunity zone within the 180-day period. So the investments typically need to be made by the end of 2021 to qualify for the minimum incentive to reduce the step up, right? Like the 5 years. So if by December 31st, 2026, taxes are due. And if you want to see a real step up in basis and reduction in your taxes, then you do want to have that 5-year window. So typically we expect that all this will come to sort of like slow down by 2021. But remember that even though you're not getting a step up, you're still going to get that tax-free growth for your money for that 10-year period. So you might not get the step up after 2021, but you'll still get the tax-free growth. Also, something to consider, and this is something I went through myself, is that I broke it down into long-term capital gains and short-term capital gains, because my long-term gains were obviously at a higher tax bracket, like the ordinary income bracket. I'm sorry, the other way around. My long-term gains were at a lower bracket, which was between 15 and 20%. It worked out to almost 18% for me. And my short-term capital gains were at a higher tax bracket, which was the ordinary income bracket. So what I chose to do was I took all of the short-term gains that I had with my stock sale and only put them in the opportunity zone fund. And then I chose to keep my long-term capital gains and pay taxes on them, because I figured 18% taxes wasn't that high compared to what the money being stuck for the next 10 years. So here are some OZ links and resources. I don't expect you to go through them, but the census tracts, there's a list of registered opportunity funds, and lots of regulations and revisions by IRS. If you're interested in a lot of detail about the Opportunity Zone Fund, this is a good place to look at the IRS details. I mean, that's pretty much the golden standard, right? You don't want to look at anything else except the IRS documents. I've also written a few blogs about opportunities on investments, and specifically about doing due diligence on OZ investments. I talked a little bit about that today, but this blog goes into greater detail. And there's also a white paper here, which I found very useful to summarize all opportunities on investment terms. So with that, I think I'm going to get the questions, and if this will let me get the questions. 1 second. So I'll look at the chat question. So the question was, can you take the funds from one QOF in year 5 to another for 5 more years and receive the benefits? Yes, you can. You can roll over the funds as long as the same funds are held for 10 full years. You can take the benefits. Can you explain more around exit strategy with refis and rollovers? I guess the question is for a sponsor. So you can ask the sponsor what their exit strategy is. So I found a couple of things, right? Like some folks were planning to build a hotel, hold it for 5 years, roll it over into another property. So you want to understand what the sponsor's exit strategy is. Are they going to refinance? Are they going to roll over into another property? Whatever the case might be, you want to understand what they're planning ahead of time. And of course, that might change, right? So there was another sponsor who was building a bunch of condos, but they were planning to maybe, it was supposed to be a multifamily unit, but they were planning to probably split and sell them as individual condos. So kind of retitle them after they were built. So lots of things that they can do with it. So let me get to the questions. If my... Looks like I have to, I somehow cannot see the Q&A box here. Let me see. All right, there it is. Okay. Can you guys still hear me? All right, it says sharing is paused. Okay. Okay, good. All right, questions. Do you have any criteria that you applied to decide on a good passive investment? This was asked earlier in the webinar, so I hope I've answered it. If not, please type in another question. I spoke about the criteria I looked at. The PowerPoint will be available for download. No, the PowerPoint will not be available. I'm sorry, I'm only sharing a PDF document. If you are a designated real estate professional, can you offset your K-1 losses against W-2 income? I believe that's a yes. It's not related to opportunity zones, but if you're a qualified real estate professional, as far as my knowledge goes, you can take the K-1 depreciation against your W-2 income for that year. Can you offset the OZ tax benefits against W-2? No, it doesn't make sense, because The tax benefits of the OZ are for capital gains only. I don't know if it's possible for you to take the depreciation from the OZ investment. That's possible to do against W-2 if you're a real estate professional. But as far as I'm concerned, the tax benefits within the OZ are within the fund and applicable just to the fund. Another question about deck available. Yes, I'll have a PDF document. Are there any good OZ funded projects available to invest locally in Austin? I have looked at an OZ project and I have my thoughts about it. I'm happy to share with it offline if you can reach out to me. I believe it's Priya. So if all the taxes are paid at year 7, how are all the gains considered tax-free after year 10? So this is how it is tax-free. So there are two gains happening here. The first gain is what you had when you sold your investment to start with before you invested in an opportunity zone fund. If you remember, I'm going to go back to this example so everybody understands this. Let's see, can you guys? All right, let's do this again. So there are two. All right, my PowerPoint is not agreeing with me right now, so I don't know what you guys are seeing. I'm just going to talk through it. If taxes are paid after year 7, how are all the gains considered tax-free? So what you pay year 7 is 85% literally of what you owed in year 0 when you invested in the opportunity fund. What you pay or don't pay in year 10 is all the accumulation within the fund itself. Remember, your fund is growing year to year, right? Like the money that you invested in your opportunity fund is also growing in addition to the growth you had before you ever invested into the fund. So the growth that you invest, the growth that is happening within the fund is tax-free. But the taxes that you deferred, you didn't avoid paying taxes, you just deferred them for 7 years, the original taxes that were due in your previous investment. So I sold stock, I invested, let's say, all my gains into an opportunity fund. That gain that I invested in an opportunity fund, I'd have to pay taxes originally, right? So what I did was I deferred those taxes for 7 years and also reduced them by 15%. But now all the money that I have put into the fund is growing tax-free because it's not being taxed at year 10. I assume I answered that question. If you still have questions, please feel free to ask. How do we verify the sponsor's credibility? Again, just like you would verify for any investment, ask questions, learn about the sponsor. Sometimes I recommend Google searches as well if the sponsor is large and they have been in that business for a while. You will find a lot of dirt on Google, surprisingly. Would all the OZ projects exit in 2026? What happens? No, okay, sorry, I should clarify there. OZ projects will not exit in 2026. All that will happen in December 2026 is all the taxes will be due. The taxes that you originally deferred for 7 years will be due in December 2026. The project goes on for 10 years as long as from when you invested. So if it started in 2019, you are stuck until 2029 into the project. I'm happy. Someone asked me about the QOF for the San Antonio Riverwalk. Is that something we can still invest in? Possibly. Please email me or message me offline. We can talk about it. Do you have any recommendations or have opportunities to invest in an OZ? I'm happy to share with you offline. Is this a business play superior to a real estate play for an opportunity zone? Why and how is a business play superior to real estate play? I don't know a whole lot about business opportunity zone investments. So like I mentioned, opportunity zone investments are not just in real estate, but they can also be in businesses. So as far as I know about businesses, you only need 50% versus the 90% to be in an opportunity fund. I think the 50% of the employees have to, or there's something about 50% there. I don't really know a whole lot about opportunity zone businesses and if they're superior or inferior to real estate. Sorry, I don't have an answer for that question. Do you have any opportunity zone projects you recommend? Nothing right now, but we can talk offline. Okay, those were all the questions. I see if anyone has any other questions, you have a few seconds or we're going to wrap up here. I hope that was useful. Thank you again for all your time. I'm happy to share this information with you because I went through this whole process. So I hope this was useful, and please reach out to me after the presentation if you have any other questions that come up later, or if you're interested in learning more about some opportunities. I don't have a whole lot of opportunities, to be honest, but I'm happy to link you up with some of them.